Hello and welcome to the first Bull and Bear episode from Kepler Trust Intelligence. This is a new series where we'll look at an individual trust, provide some background information on it, and then look at what the bear case is for it and what the bull case is for investing in it. Today we'll be looking at BlackRock Smaller Companies. BlackRock Smaller Companies has the ticker BRSC, and I'll refer to it throughout this video using that ticker, that acronym. So to get started, I'm going to give some background on the BRSC management team. So the current manager of the trust is Roland Arnold. Roland has been with BlackRock for over 2 decades. He joined the company in 2000, shortly after beginning his career in the fund management industry. Roland worked with the prior manager, Mike Princess, starting in 2006, and he was appointed co-manager to BRSC in 2018. When Mike retired in 2019, Roland became the sole manager of the trust. So he's got quite a lot of experience there. BRSC invests in UK small caps, but Roland has a broad remit in terms of size. What I mean by that is you can invest in companies that are trading on the AIM market. So, they have market capitalizations maybe below 150 million, so really at the small end. And then all the way up to mid-cap stocks, so they could have market cap up to 2 billion pounds. So pretty broad remit there in terms of size. On your screen now, you can see how the BRSC portfolio was invested by market cap earlier this year. This is from the Trust's most recent annual report. So the data is up to the end of February 2023, so it is a bit out of date at this point. But that should give you some idea of how the managers invest in terms of size in general. Okay, so hopefully that gives you some understanding of who manages the trust and what they invest in. Now we can look at what traits the management team look for in the companies they invest in. So just in very simple terms, when the managers are looking to invest in a company, what are the sort of characteristics that they look for in those companies? So, as I said, Roland has been working on the trust for almost 2 decades now, and the sorts of features he looks for in a company have remained quite constant in that time. So there are 5 key characteristics that Roland looks for, and I think it's worth looking at each of these individually. So the first one is strong management. So what I mean by that is Roland and his team are looking for effective managers that are going to create long-term value for shareholders. So obviously BlackRock is a huge asset management company, and they're in a fortunate position, which means they have really good access to company managers. So the BRSC team will usually have hundreds of company meetings in a given year. So that's the first thing they look for. The next characteristics is strong market positioning. Again, I can appreciate that might not be entirely clear. So basically what that means is Roland is aiming to look or identify companies that can dominate in the markets in which they operate. And I think the key thing to remember there is that a lot of smaller companies operate in a particular niche or a few different niches. So basically that means that Roland and his team, they're looking for things like a product or a brand that are predominant in the industry that company or that niche that the company is active in. The third characteristic is a track record of growth. So again, I think that's probably quite self-explanatory, but basically the BRSC team target companies that have demonstrated consistent growth on an absolute level and relative to expectations set by the market. The final 2 characteristics I think they're worth considering together because they sort of feed into each other. So these are, firstly, how cash generative a business is, and the final thing is the strength of the balance sheet. So obviously, being cash generative is positive in any business, but for smaller companies, high levels of cash generation mean you can fund growth internally. So if you can't do that, then you're going to have to do things like issue debt, which obviously carries risks and reduces returns for shareholders. But then it also means you don't have to raise money by issuing new equity, which dilutes existing investors' ownership. So avoiding those 2 pitfalls and being able to fund your growth. So the final characteristics was strong balance sheets. So if you think of high levels of cash generation as being useful in terms of funding growth without resorting to issuing debt or equity, it also means that you're better prepared for something like a downturn. Arguably we're in one at the moment, but like if you have an economic downturn or if there's some kind of problem that's specific to the business, kind of temporary problem, you're better able to handle that just because you've got the cash on hand to deal with that. Okay, so before we get into analyzing the bull and bear case, the final point that I think is worth highlighting here is the fact that BRSC pays a dividend. Naturally, the trust has managed to increase its dividend every year now for 2 decades. The dividend is paid semi-annually, so in June and December. And that makes the trust quite unique, among small cap funds, because a lot of them, eschew or avoid paying dividends. And I think that the other component of that is that BRSC's dividend is typically fully covered. So, the underlying portfolio generates the cash that they pay the dividend with, and I think that's arguably a sign that focus on cash flows by the manager is more than just theoretical. So that's our overview of the trusts, and hopefully should give you an idea of who the BRSC team are, how they make their investments, what they look for in those investments. Obviously, this is just a brief snapshot of the trust, and if you're interested in learning about it in a bit more depth and about some of the things that I touched on, then read our latest research note on BRSC on the Kepler Trust Intelligence website. I will put a link to that in the description of this video. Okay, so moving on to the bull and bear case. Before we start looking at this, I know some people watching may have access to more advanced sort of software or charting tools, but that's not the case for everybody. We'll be using basically free to access tools for this analysis. So if we start with the bear case, there are a couple of points here that I think are worth thinking about. One is that we're recording this in August 2023. We've just been through a very rapid rate hiking cycle, and it's plausible we're going to enter a severe economic downturn in the near future, maybe even a recession. So if you think about smaller companies in broad terms, they face a couple of key risks in an economic downturn, and those arguably haven't really been felt yet. One is that they tend to not have a broad set of revenue streams. So, if you think about a large company, it may have lots of different business lines. If one of those business lines fails, it means they can rely on their other business lines to offset some of those losses, right? A lot of smaller companies, like we said, they can't do that, and that's because they operate, like we said, in a niche or a particular area, so they don't have those diversified set of revenues. So if you imagine there's an economic downturn, and for whatever reason that niche or that area they're active in is particularly hard hit, that means they're not going to be like a bigger company. They can't rely on any other revenue streams to sort of help offset that. The other key problem that smaller companies may face at the moment is of raising money. So if you think of a small company looking to raise money, whether through debt or equity, so debt markets kind of tend to dry up in this sort of environment, cost of capital rises, and that also puts pressure on smaller companies with weaker balance sheet. And if we look at BRSC specifically, the company does invest in more growth-driven companies. So, that's true even now. If you look at the Morningstar analysis of the portfolio on your screen, and I'll also link to this in the video description, you can see that most of the metrics there show that the trust's investments skew more towards growth compared to both the benchmark index and an index of peer funds. So, like the above, this is more of a macro point, right, where we're saying that because of rising inflation and then central banks hiking rates to combat inflation, growth stocks look less attractive than they did previously. And that may also be the case in a period for a more prolonged period of time. So if you think of the post-financial crisis era up until late 2021, it was very favorable for growth investors. And you could say maybe the pendulum has swung back the other way, and we're in a period which will prove to be better for value investors, possibly, right? The final point I want to highlight here is about BRSC is that it uses structural gearing. So we've done some research on structural gearing before. Again, I'll leave that in the video description if you want to learn more about it, because it's a bit complicated. But in simple terms, what I mean by structural gearing is the fact that BRSC is consistently leveraged. So when it invests, it's always leveraged, and it achieves that through long-term loans. And the result of this process is that BRSC tends to be more volatile. So if there's a drawdown or downturn in the market, that can be accentuated by the fact that the trust has this form of gearing. Okay, so that is the bear case and some of the risks that you face when investing in BRSC. Now we'll move on to the bull case. The first point I want to make here is really about the UK as a whole and UK valuations as a whole. So most people watching this are probably aware that UK valuations are below all global peers on a forward price to earnings basis and similar metrics, similar valuation metrics, I should say. And that's been the case for quite a while now. And I think it's worth considering why that's the case. Why has that happened? So I think a key factor is obviously the B word. It's negative sentiment post-Brexit. If you look at the chart on your screen now, which is from Yardeni Research, that shows historical forward PE valuations. And you can see that actually the UK was trading at comparable levels to its peers, or even in excess of them, but a kind of gap opened up after Brexit happened. The other factor, and I actually think this is arguably a more important one, is that pension funds have pulled out of UK equities substantially over the past 30 years. So Duncan Lamont, who's at Schroders, has produced some good research on this in 2020. Those are the charts on your screen right now. Again, if you're interested in reading more about this, I'll put the link to that research in the video description. But the question Duncan asks in that research is, why did pension funds and other institutional investors sell UK equities, or reduce their weighting to them so much? One factor there was just diversification. That's a process we've seen with investors globally. So they moved to invest in overseas equities, so not in the UK, and also in alternatives. So things like private equity or real estate. But the key driver was actually a move into cash and bonds. So if you look in 1993, pension funds had 9% of their AUM, or their assets under management, in cash and bonds. Today, that's more than 60%. So if you think of share prices as being at the most basic level, like a function of supply and demand, there's been a big slump in demand on the part of UK institutions, and there hasn't really been anything to fill the gap they've left behind. So the reason I bring these factors up is basically to make the point that a lot of the falls in valuations in the UK were arguably not really driven by fundamentals. It wasn't as though these were, people looked at companies and said they were bad. It was, first of all, we had Brexit, which has caused a lot of uncertainty. That's not necessarily connected to a company's bottom line or their revenue, right? It's completely disconnected, arguably. And then you have this institutional money, which is, again, I would say maybe more important, and you have no buyers to pick up the slack and sort of replace them in the market. So, that might sound negative, but the positive sign here is that if you look at private equity and activity in the UK over the past 3 years, it's been extensive. So 2021 was a record year. The average premium paid by buyers was over 40% of the market price. Last year 2022 was obviously a bit more subdued, but we've seen a bounce back in 2023, and the number of bids and cumulative deal sizes are actually comparable to what happened in 2021, which was a record year, like I said. So the reason I say this is positive is because I think it shows there are clearly smart investors that think there are opportunities in the UK equity market. So if there weren't corporates and other private equities buyers buying these companies, they wouldn't be buying these companies if they didn't think they offered good value. And then, to top that off, the bulk of these acquisitions were in the small and mid-cap segments, which is where BRSC invests. And if you look at BRSC specifically, the trust actually benefited from some of this takeover activity in 2021, with 4 of the companies it was invested in ended up being acquired. So primarily that was a benefit from a returns point of view, because those companies were all acquired at a premium to their share prices, but more broadly, it's a sign that the manager's process works, you could say. So if private equity investors are buying the companies they're invested in at a premium, presumably the managers have picked companies that other people see opportunity in too. Otherwise they wouldn't be buying them at such large premiums, right? Okay, so hopefully that sort of sets the scene and provides a higher level overview as to why there are arguably more attractive opportunities in the area that BRSC invests in today, and why valuations again are arguably quite attractive as well. If we look at some of the more trust specific points now, I think the first point I would make is that performance is, you can't hide from the fact that performance has suffered over the past 18 months. And I think a lot of that's due to the things we've mentioned so far, right, in the bear case. So basically rates going up, a lot of economic uncertainty, leverage probably at play as well, all those sorts of things. But basically I would say the past couple of years have shown us that you can't rule out, on the one hand, you can't rule out more negative things happening and more volatility, but a lot of those outcomes are now probably baked into the share price, right? So in very simple terms and very crude terms, the bad things that might have happened, and they've sort of been priced in. And I think that there are a couple of interesting points to look at in relation to this. So one is this graph from the Montanaro UK Smaller Companies annual report, their most recent annual report. That's on your screen at the moment, and that basically compares prior years of poor performance in the UK small cap space with subsequent 3-year performance. So as you can see, and probably won't be a surprise to you, 2022 was one of the worst years on record for the UMIS Smaller Companies Index. If you look at the past year periods where the index saw substantial drawdowns like this, then in the following 3-year periods, returns tended to be positive and actually quite strong overall. Now, again, I have to say that's not a guarantee we're going to see something similar. You might have more drawdowns, you might have more volatility. But I think the basic point there is really that sort of annoying cliche, which is that periods where you have a lot of pessimism, like we've seen, tend to then present better entry points for investors. Okay, so the next point I want to look at is BRSC's holdings specifically, because I think this is where the process we talked about in the introduction, you can really see it coming into play and why it's positive. So to be a bit more specific, Roland's focus on strong balance sheets and cash generation, I think, are the two key things that are useful to think about here. So if you look at your screen again, I've highlighted some of the key points from Gamma Communications' latest results. So Gamma is a telecoms company. It was BRSC's largest holding at the end of June of this year. And as you can see, the company's latest annual results show it had close to £100 million on its balance sheet in cash. It made just under £50 million in profit, and it had £2.1 million in total debt. So I think those 3 points, again, there's obviously a huge amount of other information that's going to be in that report, but basically I think it's a very simple snapshot of that process we discussed earlier that Roland goes through. So Gamma has a very strong balance sheet, it generates a lot of cash, and it doesn't really have much debt. So, in more practical terms, that means, yes, the company may suffer during an economic downturn, but it's not suddenly going to be drowning in debt or have to go to the market and raise more cash to survive. The same is true, I think, if you look at BRSC's second largest holding at the end of June. So this is a printing company called 4Imprint Group. Again, maybe you will have heard of it already, but again, I'm going to bring up some things on your screen now that I think capture some of the key points we're looking at. So 1, the company has no debt. 2, it has $86.8 million of cash on its balance sheet. It made $80.1 million in profit last year. It got a credit facility at very favorable terms. And, the management explicitly said last year they have no plans or need to raise funding. So what does that show? I would say the same thing, right? It shows that Roland's process of identifying companies with strong cash generation and balance sheets is kind of more than just theoretical. It really is there. And more importantly for investors, those are traits which stand the company, in good stead if we do head into an economic downturn. I'm talking about 4Imprint there. So you could even make the argument that in the downturn, if we do go into one that's sort of worse than what we're in now, these sorts of companies can take market share. So because they have that cash on their balance sheet, they can acquire other businesses, or because their peers who aren't as strong as them just exit the market. And I would say that, the other positive sign for BRSC here is that the trust continues to pay fully covered dividends. I'm not saying that to make this trust sound more attractive to someone who's an income investor. The point I'm getting at there is just the fact that BRSC can pay those dividends from cash generated by the underlying portfolio rather than from capital. So that's like it's another sign that those companies in the portfolio are holding up well and are producing the strong cash flows that the managers look for. So the final thing I think is worth considering here is obviously whether this is a good time to actually invest. I'm recording this towards the end of August. The trust is trading at a 12.9% discount according to Morningstar. Its 5-year average discount is 6.3%, so it's quite far above its historical average at the moment. And I think you could say maybe that's an interesting juncture at which to think about the trust, because you have a situation where there's a lot of negative sentiment and market dynamics that have pushed down share prices and also caused the trust discount to widen quite substantially. Some of that negative sentiment is understandable, but it doesn't necessarily reflect the fundamentals of the companies in the trust's portfolio, in BRSC's portfolio. At the same time, you have these market dynamics we described. So you have institutions that have, for a long time now, been pulling money out of UK stocks. And again, that's not really reflective of the fundamentals. And those sorts of fund flows can lead to sort of pricing inefficiencies that can be positive for investors. And then we have the potential for basically a recession, more of an economic downturn. I think that's completely reasonable to be fearful of. But BRSC's underlying portfolio, as we've seen, and its share price have been hit quite hard already. So it's kind of questionable what there is left to sort of price in there. And then you look at the results the companies in the portfolio are actually producing, and they're largely good. The companies look set up to withstand a tougher economic environment or a downturn. And it's plausible they even come out of one looking stronger if their competitors leave the market, or if they can sort of take market share in some way. So I don't want to rule out more bad things happening, more volatility, the economy going down, because that can definitely happen. And I think that BRSC is likely to, or could suffer if that happens. But I think the overall point to take away is there's a strong argument to be made that the BRSC share price and the hit its NAV has taken already, a lot of that is not necessarily being driven by company fundamentals. It's more about, on the one hand, the sort of market dynamics we discussed, and then a lot of it is sentiment driven. And ultimately, that sort of irrationality is what can, in the end, create opportunities. So that's it. Hopefully this was interesting and helpful for you. If you're interested in any of the sources or things we talked about, then please look in the description of this video, and you should find links there. If you're watching on the KTI website, you may actually have to click through to the YouTube video to access those links. And if you want to read more about BRSC, learn about the trust in more detail, then please head over to the Kepler Trust Intelligence website, where you'll find our latest research note on the trust, and as well as some more information. So thanks again for watching, and see you next time.